If you're new to dividend investing and you only have $1,000, how should you invest? In this video, I'm going to walk you through different ways to invest for dividends, from low dividend income strategies to some surprising ways to get very high dividend income, with one category of investments that offer an insane annual yield north of 20%. But there are some risks. As the dividend income potential goes up, you'll find that the strategies get more and more advanced and complex. And so I hope that by the end of this video, you will have a good lay of the land, so to speak, of what are the possibilities with dividend investing, so you can decide what's best for you. We want to first start with a baseline that we can benchmark all the options against for total return and yield. But there's another measure that we need to consider as part of the benchmarking framework that we'll get to in a moment. For this baselining, we're going to use the most popular benchmark of all, which is the S&P 500. If you're really new to investing, this is an index of basically the 500 biggest companies by market cap weight, representing these 11 sectors here, and you can see that the tech sector makes up the biggest share. This is showing the growth of a $1,000 lump sum investment in the S&P 500 or the SPY ETF that closely tracks the index. Since 1994, the index has returned about 10 to 11% each year before adjusting for inflation and with dividends reinvested. And so you would have ended up with $16,436 by October 2021. From an income perspective, your $1,000 would have generated $27 in dividends in 1994, and that would have grown to $200 by 2020. So your yield would have started at 2.7% and grew to 20% over 26 years for an annual growth rate of 8%. However, if you invest $1,000 in the S&P 500 today, your annual yield will be a mere 1.26% or $13. That isn't much, and so if you're looking for higher dividend income right now, instead of having to wait 5, 10, 20 years for a decent yield, then a better option is to buy funds that specifically target high dividends. There are many traditional dividend-focused funds, with the three biggest ETFs by assets under management being VIG, the Vanguard Dividend Appreciation ETF, VYM, the Vanguard High Dividend Yield Index ETF, and SCHD, the Schwab US Dividend Equity ETF. These and other dividend ETFs like them have different strategies for selecting dividend stocks. For this video, I'm going to specifically look at SCHD and compare it to the S&P 500. SCHD holds 105 stocks of well-known companies like Home Depot, Pfizer, Pepsi, and such, with more than 9 out of 10 of them having market caps greater than 15 billion. And the ETF is overweight in these 5 sectors, with financials making up the biggest share. If we dig into the prospectus, it tracks companies on the Dow Jones US Dividend 100 Index, a subset of a more popular market index called the Dow Jones US Broad Market Index. But the ETF narrows down further by selecting companies with at least 10 consecutive years of dividend payments, with a minimum market cap and liquidity, and these other metrics here. Finally, no single stock can represent more than 4% of the index, and no sector can represent more than 25%. These requirements result in the ETF having a yield of 2.88%, more than twice as much as the S&P 500. And when we look at how it performs compared to the index in terms of income, SCHD has clearly grown its dividend much faster than the index since its inception in 2011. If you invested a $1,000 lump sum in 2012, SCHD would have generated $99 in 2020, while the index would have paid you $54. However, what you would have gained in income, the index would still have given you a higher overall return. Again, without inflation adjustment and with dividends reinvested. Here, we're looking at the difference of about $450. The takeaway here is that generally speaking, dividend income and overall returns have an inverse relationship like this. If you want higher overall returns, you need to expect zero to little dividends. If you want high dividends, then you can't expect to have high overall returns. So on the trade-off between overall returns and dividend income, you can imagine the S&P 500 lands somewhere here on the trade-off, while SCHD lands somewhere around here, where you get a bit more dividends but a bit less overall returns. And so it shouldn't come as a surprise that as we look at higher and higher dividend income options, our overall returns is going to be less and less. And critics of dividend investing are quick to point out that this is why it's a bad idea to invest for dividends. And sure, you may be less wealthy overall by investing for dividends, but that doesn't mean you won't be more satisfied and happier in life, because dividends can buy you back something that you can never get more of, which is your time. In other words, you should think of the value of your time being another metric you should consider in relationship to dividend income. And here, the relationship is positive in that the more valuable you consider your time to be, the more it makes sense to lean towards investments with higher dividend income because it buys you back more time. So whether you want to grow your investments as much as possible or start earning more passive income with dividends to make life a bit easier right now, there's no wrong decision here. But if you are in the latter category, then the next few dividend income options might be just what you're looking for. Before moving on, if you're getting any value from this video, hit that like button, and also if you have at least a penny to invest, you can get 2 free stocks worth up to $2,300 when you open a Webull account and make any deposit. It's a free trading app and there's no cost to use the basic service. So be sure to get your free stocks now by using the link in the description. Now, as SCHD somewhat hinted at, some sectors of the economy pay out higher dividends than others. And so one way you can boost your dividend income is concentrating your dividend portfolio towards higher paying sectors. Based on data from Sibyllis Research, companies in the consumer staples, energy, financials, real estate, and utility sectors tend to pay higher dividends. This doesn't mean you have to research and buy individual stocks, but instead you can look into sector ETFs such as the Invesco KBW Premium Yield Equity REIT ETF. This real estate ETF holds 29 REITs or real estate investment trusts and pays out a 5.6% dividend yield. When we compare the income you would get from this to the S&P 500 and SCHD, you can see that it has paid out substantially more every year with the exception of 2021. Even during the 2020 pandemic, when REITs took a big hit, it would have still paid out $158. However, it should come as no surprise that it underperforms both of them when we look at the overall returns. A $1,000 investment into the real estate ETF would have barely doubled over 10 years compared to increasing by 4-folds or more for the other two. Now, this trade-off may be acceptable for you, but not every high dividend paying sector works out this favorably. For example, another sector that tends to pay even higher dividends than real estate is the midstream energy industry. These companies, which are commonly structured as master limited partnerships or MLPs, build and operate oil and gas pipelines from the point of extraction to the refineries, as well as store and process petrochemicals for other energy and manufacturing companies. If you look at the two most popular midstream ETFs, that's the ALPS Alerian MLP and Global X MLP ETFs, they pay around a staggering 8.5% dividend yield today. But when we look at the income trend of both of these compared against the S&P 500, since 2013, the dividends haven't really grown much, while the dividends from the index shown in blue has been gradually increasing. And when we look at the overall returns compared to the benchmark with a $1,000 lump sum, both MLP ETFs would have lost more than $100 over the course of 8 years, and this is with dividends reinvested. Now with SCHD and the Invesco REIT ETF, the trade-off of lower returns for higher dividends may have been acceptable, but in the case of these MLP ETFs, even with higher dividends, you're losing your initial invested capital, which should raise a red flag. In this case, it doesn't make sense to invest sector-wide for high dividend income. You might be better off investing in individual MLPs or looking elsewhere. The next group of high dividend paying investments I want to share are covered call ETFs as well as exchange traded notes or ETNs. These can generate very high dividends, but come with their own set of risks. These are not your traditional dividend-paying funds that rely on the profitability of the underlying companies. Instead, they generate income by selling covered calls on their holdings and pay out the income as dividends. I talk about covered call ETFs a lot on my channel, but if you're new to them, I would recommend watching this video here where I explain more in depth on how they work. Bottom line is, if you're investing for the highest dividend income possible, a portfolio of covered call ETFs might be your best option. The two highest paying covered call ETFs that you should be aware of are QYLD and RYLD, and they currently pay 11.4 and 11.6% respectively on a monthly basis, so you will get paid about 1% of your investment amount each month. QYLD is the Global X NASDAQ 100 covered call ETF, and RYLD is the Global X Russell 2000 covered call ETF. Now, QYLD is about 10 times bigger based on assets under management, but it had about a 5-year head start. But regardless, both use a covered call strategy to generate their double-digit dividend yields, with the only difference being which index they are tracking. In the case of QYLD, the fund directly holds the top 100 companies on the NASDAQ, while RYLD tracks the Russell 2000 index by holding the Vanguard Russell 2000 ETF. Now, in terms of the income history, I'm going to focus only on QYLD here because RYLD's history is really short and it's pretty much consistent with QYLD. But you can see that this year, QYLD generated nearly 7 times the income you get from the S&P 500, and it's either kept pace or grown faster than the benchmark. And when we look at the overall returns, QYLD generated about a 9% annual return since 2014 compared to 14.5% for the index. However, if we turn off dividend reinvesting, your $1,000 investment would have lost $106 over this time period, which is roughly about 1 year's worth of income over the 8-year period. So the question is the trade-off worth it for you if you are looking for high dividend income? The good news is there are other covered call ETFs that you can combine with QYLD to fine-tune your dividend and overall returns. In this video here, I show you how to build a dividend portfolio using QYLD and other ETFs to do just that. So check it out after we cover ETNs, which you don't want to miss because this is where it gets insane. Now, there's many different types of ETNs, but there's 2 ETNs that I want to bring to your attention, which is the Silver Covered Call Options ETN and the X-Links Crude Oil Shares Covered Call ETN. They pay an insane 26% and 21% dividend yield based on the trailing 12 months, with USOI averaging 30% in the past 4 years. When we look at the income history, these funds dwarf the S&P 500 by magnitudes. In 2020, you would have received $270 and $181 from these ETNs compared to just $22 from the benchmark. However, just like the other high dividend funds, you can see here the overall returns is lower than the S&P 500, with the crude oil ETN having been hit really hard during the pandemic. When we switch the performance to no dividend reinvesting, you can see that the ETN is down 33.5% since 2018, and the silver ETN is down about 10% on an annual compound basis. Exchange traded notes are just like ETFs in that they trade on a stock exchange and are tied to an index, but this is where their similarities end. ETNs are unsecured debt issued by a bank. In the case of SLVO and USOI, these are issued by Credit Suisse, and you can see the index each of them are linked to here. On the other hand, ETFs own a basket of securities, and more importantly, it's legally separated from the companies that manage them. So if the company behind the ETF goes out of business, the investors of the ETF are safe and still own the assets. So the implications are that ETN investors need to consider the market risks, as in the movement of the index, and the risk of the issuing bank being unable to pay its debt, because essentially these are bets on the index's direction guaranteed by the bank. As for the huge dividends, you can see here that each ETN pays a monthly variable cash coupon based on the notional option premium received from selling call options. Notional value refers to how much value is represented in this case by the debt contract, which differs from market value, which is based on supply and demand. Now, I caution any investor from buying ETNs without digging further into how they work, because you can potentially lose a lot of money. In any case, due to how much they're tied to the performance of their respective commodities, they should only make up a small portion of your entire portfolio. So yeah, while the yields on these are very attractive, these are very complicated investments, and I'm personally researching more into these ETNs and others like them. That's it, guys. If you found this video helpful, be sure to hit that like button and don't forget to subscribe to the channel. Thanks for watching, and I'll see you guys in the next video.